morning, everyone. Oh, yeah, Zach's got his daily Huddle mug, so he is officially, look, you're not in the screen.
Repping my group. That's because you're taking up all the space.
Well, just kidding. All right, well, it's centered on me. You can squeeze into
As is the world.
You can squeeze into my space.
So,
Welcome to the Daily Huddle. It is Monday, May the 6th. And I'm Kimberly.
and I'm Zach. And we're here to bring everything from the last few weeks to tie a ribbon on it. We're excited to be back home again. We've been gone for a little while doing our big tour of Atlanta and educating people all across the metro area on financial concepts and those kind of things. So we're glad to be back here with the Daily Huddle family. Even though we haven't missed a week, it feels like we've been gone. But we're back in our office in our hometown. So glad to be here.
Yeah. So, like Zach said, we had a whirlwind, I guess, last 10 days, traveling all over Atlanta and teaching financial concepts. And it was under the hashtag, I guess, of financial revolution and just bringing money concepts to everybody, right? Normal, everyday people. And Atlanta's so big that we decided we couldn't just stay in one location. So we went to different cities every night and had a ton of people check in and join us on that tour. So I feel really good about what we did. We spread the news of financial literacy and, just hope and opportunity and possibilities and, hoping or attempting to work with that mindset and that paradigm shift that we talk about every single Monday on the show. How money works, right?
Yeah. And so our question for the day is, do I need life insurance? And so that's one of the things that it was humorous as we talked to people all over the past week, but also over the last couple of decades about life insurance, how misunderstood and misunderstood the need for life insurance is. So Kimberly will break down in just a minute the process of determining exactly how much somebody needs. But I like to stand in front of a room and ask people, some of you guys may have seen my presentation about insurance and what it actually protects. And I use the analogy of, does health insurance keep you from getting sick? No, it protects you from having to dip into the bank or put medical expenses on a credit card. It protects your assets. It protects what's in the bank or what's not in the bank, right? It protects you from going in the hole. And the same thing for automobile insurance. Does your car insurance protect your car from getting in a wreck? Not at all. It protects your bank account or your pocket from having to go backwards if you have a wreck to pay for those things out of pocket. And then I ask everybody, but do you have car insurance? Most people in the room raise their hand and say yes. And then I say, well, do you have health insurance? And, half the people or more than half will raise their hand and say yes. And then I ask, do you have insurance on your cell phone? And 90% of the room raises their hand. And then I say, how many of you have life insurance? And, half maybe raise their hands, or they say they have it, but when they start discussing how much, they don't have enough.
Or it's only through work.
Or yeah, correct. So I like to use an analogy when I talk about life insurance. Life insurance on a loved one can be a very emotional and sticky feeling, right? It's not that you're replacing that person with money if something were to happen to them. You really have to remove the emotion from the decision and look at it from the perspective of, so if the two of us we're married, obviously, but if one of us has an income stream and our family needs both of our income streams to function, then we have to insure that income stream, right? So I like to talk about it in two different ways. There's no way you could replace me if something happened. But a loved one that is lost is an emotional disaster. It can be an entirely emotionally draining, uprooting everything else. So the last thing you want to have to do in a family situation is deal with financial strain at the same time. So that's one reason to have life insurance. But the way I like to explain it in more just common terms to remove the emotion out of it, if you had a machine that you kept in your garage, and every year it printed out $100,000. Now, we're not talking about fake money or a counterfeit operation. I'm talking about a machine that made an income of $100,000 every year. And would you insure that machine? See, like I said before, we insure our cell phones because we know if we drop it, like I did mine, that it's gonna cost us a good bit to get that fixed and to get things back on track. But that machine is our ability to provide or to earn an income. So you have to think about that from that perspective of, I'm not ensuring my love or my peace or my satisfaction with I can't replace that with money. I can't bring this person back with money, but I can ensure the income that they provide. I can protect my family from a financial disaster while at the same time protecting our future, don't have to move, all those kind of things. So that's more like how to look at life insurance and why. And so the answer to the question of the day for me, as Sorrel sent back laughing last night, is yes, I need life insurance. My family is still young, and we are still actively working, so we need to make sure we cover those holes. So I'll give it to Kimberly so she can talk about how we determine how much life insurance I need.
Well, before we do that, I want to talk about life insurance, right? Nobody wants to talk about life insurance, and nobody grew up saying, I want to be a life insurance salesman, right? But ultimately, it is a huge need in our financial plan. What is life insurance and what does that do for us? So, for most of us, we understand that life insurance is a death benefit, right? If I die, if I pass away, my family is taken care of through that death benefit. But some of you may know, some of you may not know, life insurance is also a living benefit. And living benefit means that you can reach in and access a portion of that death benefit to help you through a sickness or a major illness. And that used to not be that way, right? Probably in the last maybe 5 or 6 years, that's changed. And that's a really big deal. So now, should you have life insurance for a death benefit? Of course. But are most people more likely to get sick than die? Yes, of course they are, right? Our healthcare industry in our company has gotten, or company in our company in our country has gotten so much better, right? So most people, if they get sick, they get better, which we're excited about. We want to happen. We want everybody to live forever, right? But financially, it is a huge burden on their family to have a diagnosis. So a big question that we ask in terms of life insurance is, can you afford a diagnosis? A lot of times, and we'll talk about this in a second, but we talk about how much life insurance do you need? And what if you're a non-working spouse? Do you need life insurance? What does it look like? What if you don't have any kids? Should you have life insurance? And I think now with the living benefit piece added to that, most people can't afford life insurance and long-term care and disability and all the what ifs that insurance can cover, because there are a lot of different things that you can protect against and a lot of different policies that you can buy. So having one policy that at least touches on all of those different areas is a really big deal. So I'll just finish explaining that really quickly, and then maybe we can talk about a story about it. But living benefits, what is the difference of how it used to be? So again, death benefit is on every single life insurance policy. If you die, the death benefit goes to your beneficiary, whoever that may be, for whatever they choose to use the money for. But what if you live? So there's always been a terminal rider on a life insurance policy. So if you have a terminal illness, usually diagnosed by a doctor to be terminal within the next 12 to 24 months, then you could accelerate a portion of that death benefit. But they've extended those terms over the last 5 to 6 years. And so now it says, if you were to be diagnosed with cancer, have a heart attack or stroke or something major like that, that's considered a critical illness, and you have the ability to reach in and access a portion of that death benefit to help you through that time. It also covers chronic illnesses, and chronic illnesses means that you can't do 2 of the 6 activities of daily living, which is like toileting, bathing, feeding yourself, getting dressed by yourself. So if you can't do 2 of those 6 things, you qualify for a portion of that death benefit to use during that time. So I wanted you guys to understand that it's definitely more diversified, if you will,
Yeah.
than it ever used to be before. So before I go into the purposes of death benefits and life insurance and how we figure out how much life insurance you need, you want to tell a living benefit story and kind of just give people a little idea of what that looks like and why it's so valuable?
Yeah, I mean, unfortunately, I have personal family experience with living benefits and how they work. There are stories. We have video that was put out by AIG several years ago talking about the benefits of this type of rider, and that's what it is. It's an add-on to a life insurance policy. So if you think you have life insurance, you need to double check and make sure that it has living benefits. If it doesn't, then it's definitely something you want to revisit and see about replacing that with a policy that does, if it fits for you. But bottom line, if you take in this situation, I'm not quite sure what the original face amount of the policy was. But my aunt was diagnosed
I
with
think it was like 400,000.
she was, I think that was what the check was, like 300 and something, but I think that she was diagnosed with unfortunately she was diagnosed with stage 4 breast cancer. And this was after having had a term policy in place for less than a year that was fully medically underwritten. So that means they did blood work and all the other stuff to prove her eligibility for this. And when the diagnosis came through, she submitted all the paperwork and all those kind of things through the AIG process, and they actually paid her prior to her death 300 and some $1,000. Which the reality of that is it allows you to make your choices, right? That without having to wait. Now, she could have not done that and waited and let her beneficiaries get the death benefit, but instead, she was given a very brief amount of time to live, and I believe she extended her life expectancy by 5 or 6 years.
Yeah. And just having choices, like Zach said, unfortunately, it did not save her life, but it did prolong it. And she was able to do alternative treatments, and she was able to, she loved beach houses and being down at the beach and working on her beach houses and all of that. And it allowed her to have that money without the concern that she could do whatever she wanted to do. And I do think that it probably extended her life for 5 to 6 years. Because of her alternative treatments and the fact that she had the money to afford to do those things. So when we talk about life insurance, it's not just what if I die, it's also what if I live, and how do I want to, how do I want that to look? So I'm going to share my screen for a second, and I want to go over just a couple of cornerstone pieces of life insurance and how we use them in our company. So you guys have probably seen this before, but with every single person that we sit down with, we have an initial conversation, talk about their goals and dreams, where they are, and where they want to be, and then we put a plan together for them to get there. When we look at that plan, we look at every single one of these 6 steps in order to give them suggestions to actually make that plan complete, right? We don't want to just have a plan. We want to actually get to our end destination at some point, right? So step number 1 is increasing cash flow. If you came to our events last week, a big part of my story was it's not that we don't make it's not that we can't manage the money that we make, it's that we don't make enough. So we always need to be looking at how to increase our cash flow, how to make more money, how to diversify our income. Step number 2 is debt management, consolidating debt, eliminating debt, making sure that that's something that you don't have to focus on anymore. Step number 3 is emergency fund. We should all have 3 to 6 months income to prepare for unexpected emergencies. We all remember COVID, right? Thankfully, it's in our past now. But for that moment, it was super unsettling. Even if we had our secure W-2 jobs and guaranteed income, for a lot of us that changed, right? For a lot of us, we lost our jobs, or we had a good 3 to 6 months out of work, and it really hurt financially. So understanding the need for an emergency fund, I think, is more clear now than it's ever been before. And step number 4 is proper protection. That's where the death benefit and the living benefit conversation comes in with life insurance. Most people, when they sit down with a financial planner, right, or a financial coach or a wealth advisor or whatever you want to call it, they want to just go to step 5. They want to build wealth because that's what's sexy, right? If you want to have a lot of money and live on a yacht, you got to build wealth in order to do that. If you actually want to retire one day, you got to build wealth in order to do that. But if we don't start with step 1 and get all the way to step 4, which gives us a proper foundation for our plan, right? Then regardless of how much wealth we build, one diagnosis, one emergency, one financial crisis takes it all away because we didn't put our proper foundation on our house. You know, we talk about really steps 1 through 4 being the foundation of a house. And you wouldn't put a roof on a house without walls, would you? Of course you wouldn't, right? It just come crumbling down all around you. So we have to make sure that we have this in the proper order, and then we can build wealth and preserve wealth. But step 4 is proper protection. That is really the first part of a financial plan. If you look at it in a different graph, if you will, the very bottom is defensive planning. You have to protect, which is life insurance, what you earn, what you own, what you owe, and those you love, right? That is the base, that is the foundation. Then you can plan for major purchases, emergencies, college planning, retirement, and then obviously prioritize your goals towards how you're going to plan for that, what you're going to pass along, and then ultimately your wants at the end of the day, right? Like the yacht. One day I'll see us on a yacht. I don't know that I'll own it because I don't know that that's fiscally responsible, but I will be on one for a minute, right?
Sure.
You want to say anything about these two before I
Well,
go
I just
forward?
think that you know, when you look at life insurance and where it fits in a financial plan, you got to look at what the goal is from that plan from the very beginning. The goal is for you and your family to be able to retire or to be able to live without worry for the rest of their life. So the only way when you're starting, if you're starting at 0 or you're starting brand new, the only way to make sure that that happens is to protect that. And we have what we call the theory of decreasing responsibility, which means that when you're younger, you have more. I don't know if you're going to pull that up. You're probably not.
I hit it.
She hit it. Okay. So when you're younger, you have probably more liabilities. You have more expenses with children and those kind of things. If that's what you choose to do. So the idea is that you buy more term insurance or cheaper insurance at a younger age. And then as you get older, you need less because you can self-insure or because your savings have gotten to a certain point. My theory has really been now, because a lot of the buzzwords and a lot of the things that we talk about are generational wealth and inflation, and the dollar may not be worth what it was yesterday, tomorrow. So my theory has kind of changed on that. And I believe that we should definitely protect based off of the dime theory, but we should also not necessarily taper off a whole lot or go away from life insurance in general just to create generational wealth.
Yeah, it's definitely a way to rent dollars for pennies. Is that what we've heard before? Because life insurance is so inexpensive when you compare it to the death benefit that you're actually purchasing. So I want to show you guys also in this quick little slide presentation, how do I know how much life insurance I need? This is a conversation I have with all of our clients every single time, and we use the exact same formula for everyone. Because I think it matters to, instead of just saying, I think I need $250,000 worth of life insurance, I think it matters to understand how much life insurance you actually need. So we use what's called the DIME method. DIME stands for debt, income, mortgage, and education. So if you look in this example, this particular client has $75,000 in debt, and they make $50,000 a year. I don't know if I can highlight this. I probably can't. But if you look to the right, they make $50,000 a year in income, and we want to replace it for a 15-year period. So if you multiply 50,000 times 15 years, that's 750,000. The current mortgage balance that they owe is 275,000, and then they have 2 children they want to put into college education for 4 years, and that's 480,000. So the total life insurance need for this particular client is $1.5 million, $1,580,000. I will tell you in the income section, rule of thumb in the industry is a minimum of 10 years of income replacement. So if you have a $50,000 income, minimum 10 years income replacement is 500,000. They use 15 years in this example. And a lot of times, if you have younger children, if you had a 5-year-old, I'd probably use 15 years. If you had a baby, I'd probably use 20 years, because we want to make sure that the income in that family and the income in that household doesn't change until that child is an adult. Because like Zack said, emotionally, your family is going to be devastated regardless, but financially, they don't have to be. So I just think it's important to know and remember, as far as a death benefit and a life insurance conversation, it is not just how much should you have in life insurance if you die, but it's also how much do you want to have access to if you live. If you've got $1.5 million in life insurance and you had a diagnosis and you reached in and pulled out $500,000, well, you don't have $1.5 million worth of death benefit anymore, right? So lots of big conversations. Another thing to understand and to know about life insurance, and do you need it? Yes. Typically, like Zack said, it depends on the client and how it works and what their entire picture looks like. But a lot of times we do two different policies. We'll do a term policy for that big death benefit need because they have a big need when they're younger and they've got kids and more responsibility. And then we'll do a permanent policy for a smaller death benefit because we will also use it as a retirement savings plan or something like that, where they can access that cash value later. But in doing so, I think one important thing to note is that we preserve the insurability. So whether you can afford a permanent policy now or not, right? Number one, it's got to be affordable, because if it isn't, you're going to cancel it. And when you die, you won't have life insurance, and it doesn't matter anyway, right? So whatever that is, put that in place. But number two, that term policy, if you will, if that's all you start with, it preserves your insurability. What does that mean? Those policies are guaranteed, the ones that we sell, maybe not all of them, but the ones that we sell are guaranteed convertible, meaning that your health today dictates if you can have that policy forever. So convertible means that I can change it from a term policy to a permanent policy during the duration of that term. So if we say it's a 20-year term, that means that for 20 years, you've got this life insurance policy with this standard payment that's never going to change, right? It's this guaranteed minimum payment for this particular period of time. And at the end of 20 years, it goes away. Well, what happens if you want more life insurance at the end of 20 years? And most people do. So understand that. Most people, when they run out of life insurance, they're like, I wish I'd gotten more, or I wish I'd gotten it for longer, because it's cheaper the younger you are, because your health is better and your risk is less. So from that perspective, having the ability to convert it, let's say in year 19, I have a major diagnosis and I'm like, oh gosh, I'm never going to qualify for life insurance anymore. Now with that convertibility piece, you can say, hey, I got this $1.5 million death benefit. I want to convert 500,000 because I want it forever. And that 500,000 that I choose to convert is based on my health when I originally took out the policy, not my health today after that diagnosis. So that's a big deal. I think it's a good safety measure, if you will, to preserve your health and preserve that insurability and, have the opportunity, because nobody knows what tomorrow brings. So having the opportunity to have access to it later is a big deal as well.
Yeah, absolutely. So it's part of a plan. And basically, you guys know, if you've been on here with us or you've seen us anywhere before, that's what we believe in, is a full comprehensive look at what your goals are, and then how does your planning point you to those goals. We're all on a road, financially, physically, everything else. The question is, does that road take us where we want to go, or are we going somewhere different? So we like to make sure that the destination at the end, our goals, if you will, are at the end of the road we're on, and we don't need to just change direction and try to reset some things. So a lot of times we sit down with folks and they are pointed in the right direction. They might need a little adjustment right or left. Physically, I think we're all trying to get on the road in the right direction and stay on it.
Chase's part, right?
That's right. That's right. So
Chase can keep us on that track.
But
or that help.
But yeah, we can open it up for some questions. We've got about 3 or 4 minutes left before we wrap everything up. Anybody have questions about things they've dealt with in the past or stories? Anything they want to share before Kimberly and I keep running our mouths?
Aw, sweet comment, says Chase. Because we're so sweet, Chase. You know that, right?
Well,
hey guys, this is Sheila.
Good morning.
Good morning. I'm going to tell you something that I learned something new today. And I thought that was amazing. And I cannot believe how awesome that training was. I just have to say it. It's probably the best I've heard. I don't know. I'm going to say at least 10 years, you guys. That was awesome.
Well,
thank you,
Sheila. Thank you for joining in.
Absolutely. So, thank you for the compliment. I'm glad that you were here for that and that you got some good stuff out of it. So, good morning, Ron. How are you?
Hey, good morning, guys. Good morning. It was great. It was a great. I can say for the last bit, on the meeting the other day. I'd like to find out. I mean, and I think I left exactly when the fellow was going to talk about the IRA.
You did.
What's the information about IRA lately? IRA, you could call it.
Yeah, so we'll do that on maybe one of the upcoming Daily Huddle podcasts. We've got that presentation, so we'll hit the highlights of that because I think it's very valuable and very good. But the last part that you missed, I'm trying to think of who all it was, but it was about Roth conversions and how to pay less money on how to pay less taxes on your IRA. Because obviously we know that money going into an IRA is qualified, right? We haven't paid taxes on it. It grows tax deferred. And then when we access it, we're going to pay taxes. Are taxes going to be where they are now? Or do we think taxes are going up in the future? Probably going up, right? So does it make sense to start that conversion and pay taxes now and reinvest into a Roth so that everything that you make inside that policy grows tax-free? Well, it still grows tax deferred, but you access it tax-free. Probably so. And so that was the big conversation at the end of, how to strategically do that without increasing your tax bracket now. Just understanding all those different thresholds.
Yeah, we sit down with people every day that don't understand that they still have to pay tax on their IRA or 401k funds. And it's shocking that we go through the entire career getting a tax deduction and putting that in there and watching that 401k grow. And then we realize at the end of the day that it's that balance is not all mine, that I have a partner in my retirement account and that's Uncle Sam, and he's going to get his piece. And ultimately that realization is difficult for a lot of folks because they're doing math. If you look at 4%, which is the general rule of thumb that you can take out of your retirement assets without depleting them, and they're doing that 4% math based on the full amount, and they realize, wait a minute, in order to get a $55,000 a year bring home, I've got to take out 70 out of my 401k, out of my IRA. So we'll talk about that in a little more detail at a later time, but generally the message is the tax rates are on an upswing. And we've seen that for 15 years now. This is a gradual, it's kind of holding steady, but gradually going up. And so when people realize that they've deferred tax at a lower rate to then later pull it out and pay it at a higher rate, they get upset, they get frustrated. So then it's about creating avenues to get that money out systematically to reduce the impact of taxes. And that's what we talked about. So we'll do that. It's a whole other conversation, but we'll do that on one of these huddles pretty soon. That's called IRA Mastery.
Okay. All right.
And I know you wanted to meet individually as well. So I'll text you when we hang up and we'll just schedule a time to Zoom and answer your questions specifically outside of the daily huddle. But we'll also give all of you guys that amazing tidbit of information.
Yep.
Right? And thanks
All
for
right.
coming this week. We
Sure.
appreciate
Sure. It was good. It was good.
Yeah.
Good.
Awesome. All right. Well, guys, we are, it's Monday, right? It's time to go out and conquer the world and attack the day and make this week your week. So remember, as we sign off today, to love, laugh out loud, stress less, eat mostly plant-based, give, sleep, move. Can you move? And finally take your pause, right? The moment between stimulus and response is the most powerful moment that you'll ever have. So take your pause and check yourself before you wreck yourself. Thanks for joining us today, and we'll see you tomorrow on the Daily Huddle. Bye, guys.